Markets tumbling after Fed Chair Jay Powell reiterated his hawkish stance and warned of more pain ahead. The S&P 500 ETF, ticker SPY, selling off on the news. For more on this and the road ahead, we have Sean O'Hara with us, Pacer ETFs President, as part of this week's ETF report brought to you by Invesco QQQ. Nice to see you, sir. If there was an enduring message from Jerome Powell that's reflecting in the markets today, what is it?
That they're not giving up. They're still committed to trying to stem the tide of rising prices and inflation. They're not convinced that their job is over yet. And so we'll have to continue to watch what they do. It's a little surprising, to be honest with you, that we had some bad economic numbers on the manufacturing side. We had some bad retail sales numbers this morning come out. And so it looks like what they've been doing, which sadly is trying to destroy a certain part of the growth in the economy to tamp down inflation, is starting to work. And so, it's a little surprising that the market doesn't view that as a potential, good news story in the bad news that's wrapped up in it, because it would be an indication that what they've done so far is accomplishing their goal, and perhaps they don't need to be quite as aggressive as they have been. But as of yesterday's, Mr. Powell's speech yesterday after their meeting, it doesn't look like they're going to stop along their path of continuing to raise interest rates.
So, Sean, what does all this mean then in terms of a risk of recession? And if we do get a recession, how deep could that be?
Well, I think it's possible we're already sort of in a recession, we got here because the Fed said that inflation was transitory, and so it got away from them, right? And so now they're having to be sort of overly aggressive to kind of rein things in. And I'm concerned that over aggressiveness might not, result in what they're hoping for, which is sort of a soft landing. I think we may have potentially a little bit harder landing than what people think. And so, if there's good news in that, historically speaking, that the stock market tends to react 6 months in advance of that recession starting. And so, if we're nearer to this recession starting, if there's going to be one, and if there's a silver lining in there anywhere, we may be closer to a near-term bottom in the market.
So given what we're seeing in the market today and your prediction of a hard landing, what are you telling investors? Any sector safe to hide?
Well, this year, we have succeeded in creating positive returns from one of our large cap ETFs, COWZ, by positioning the portfolio in energy, healthcare, and materials and moving away from consumer discretionary and tech. It's not likely that that will change anytime soon. So I think you have to be in some of the more defensive sectors. I think if you think about where to invest in this kind of an environment, high quality stocks that generate a lot of free cash flow, that have a high free cash flow yield, are things we love. They tend to pay dividends, grow dividends, and buy back their stock. Or strategies that people can use to sort of mitigate some of the downside risk. And we have a strategy that ALTL is that ticker, and it moves from high beta to low vol, and it's been in low vol most of this year. And so on a day like today, it's down a little bit, but it's only down about half the market's down. And so those types of strategies in this type of environment have worked out pretty well for the investors here at Pacer ETFs who own them.
Yeah, Sean, within the healthcare sector, that's interesting because we know the healthcare sector has fared better than the S&P this year. When you take a look at BlackRock and also Fidelity, they have two large healthcare ETFs that have actually outperformed the S&P by about 10% year to date. More specifically, when you're looking within that sector, I guess, how are you picking out the winners and losers?
Well, we screen for free cash flow yield. So the free cash flow yield is the free cash flow a company generates divided by its enterprise value. And enterprise value is market cap plus debt minus cash. So it's essentially a calculation that says, what am I going to pay in total to buy a stock? And how much free cash flow will it give me in terms of current return? And so that's what's led us to the healthcare sector. Earlier this year, energy was carrying all the weight for our portfolios because we were very, very heavily weighted energy. We still are. But I looked yesterday, and I think 6 out of our top 10 names are healthcare names, like Moderna, Regeneron, Gilead is in our portfolio, AbbVie's in the portfolio. So, the interesting thing about the healthcare sector, Seana, is that it's the only sector that has not seen over the last decade or so its stock prices go up faster than its earnings. Tech at one point had seen their stock prices go up more than double their earnings. And so that's what I think we're seeing in the tech sector right now, is sort of a compression of that multiple. Same thing is happening to growth stocks broadly. But healthcare, the stock prices actually went up low or less than their overall earnings. So we're not subject to that same multiple contraction in healthcare. And so as a defensive place to be, it's been a real big winner for us.
So the message here, stay defensive, at least for the first part of next year. Sean O'Hara, great to have you. Thanks for joining the show this afternoon.
Thank you so much.